You are looking at $13,099.75. That's how much you would actually pay your credit card company for a $5,000 debt if you only paid the minimum amount every month. It would take you 19 years and 2 months to pay it off. That's $8,099 in interest alone, more than the original debt. This is Rights Decoded. Today we're decoding the federal rule that tells you exactly how much your credit card will cost. The rule that's been on every statement you've received since 2009, and the math the credit card industry hopes you'll never do. You've seen this box. It's on every credit card statement, every month, on every card you own. The bank is required by federal law to put it there. They're required to show you, in plain English, how long it will take to pay off your balance if you only make the minimum payment. Most people don't read it. Roughly 4 in 10 cardholders even look at it. Most just check the balance, glance at the minimum payment due, and tap pay. This box exists because of a federal law called the Card Act of 2009, Credit Card Accountability, Responsibility, and Disclosure Act. It is one of the most important consumer protection laws in modern American banking, and you, like nearly everyone else, have probably never read what it's trying to tell you. May 22, 2009. President Barack Obama signs the Card Act into law. The country is 2 years into the Great Recession. Millions of Americans have lost their homes, their jobs, their savings, and credit card debt has become the slow bleed underneath all of it. Before 2009, credit card companies could raise your interest rate without warning, apply your payment first to your lowest interest balance so your highest interest debt kept growing, charge you over-limit fees on top of your existing debt, issue cards to college students with no income, no job, no ability to repay. The Card Act ended most of these practices. 45 days advance notice before any rate increase. Payments applied to the highest interest balance first. Restrictions on issuing cards to people under 21. And, most importantly for today's episode, mandatory disclosure of exactly how long the minimum payment trap would last. Section 201. Payoff timing disclosures. The law that put the box on your statement. So what's actually in the box? By federal law, every monthly credit card statement must contain a section called the minimum payment warning. It has to be clearly visible, it has to use specific language, and it has to show you 3 specific numbers. 1. How long it will take to pay off your current balance if you only make the minimum payment. 2. The total amount you will pay, including interest, if you only make the minimum payment. 3. What you would pay each month to clear the balance in 3 years and how much that would save you. 3 rows of data, boring on the surface, devastating when you understand what they mean. There's a 4th element most people miss entirely. By law, the box has to include a toll-free number for nonprofit credit counseling services. The Federal Reserve picked it. It's free to call. It goes to a licensed credit counselor who can negotiate lower interest rates on your behalf and build a payment plan. It's right there on every statement. The Card Act mandated it. Almost nobody calls it. That 3rd row of the box, the one showing the 3-year payoff number, is the most important sentence on your entire statement. It's the bank, by law, telling you the cost of doing the easy thing. If your statement says you'll pay $8,000 in interest on a $5,000 debt over 19 years, that is not a theoretical projection. It is the legal disclosure of what your actual life is going to look like if you do nothing different. And almost nobody reads it. Let's do the math slowly so you actually feel what it means. You owe $5,000 on your credit card. The interest rate, your APR, is 22%. This is not extreme. As of 2026, the average U.S. credit card APR sits between 21 and 23%. This is a normal, middle-of-the-road credit card. Most major banks calculate your minimum payment using the same basic formula. 1% of your balance plus any interest charged that month, with a floor of $25. Month 1, your balance is $5,000. The interest that month is $91.67. 1% of your balance is $50. So your minimum payment is $141.67. Of that $141.67, only $50 reduces your actual debt. The other $91.67 evaporates into the bank's profit. It's gone. It doesn't lower your balance. It doesn't help you. It is the price of having the debt for one more month. Month 2. The balance has dropped, but only slightly. 3, 4, 5, 12 months in. After one full year of making minimum payments on time every month, you have paid the credit card company $1,610. Your balance has dropped from $5,000 to $4,432. You paid $1,600. Your debt dropped by $568. 65% of every payment that year went to interest, not your debt. To put it another way, you were paying the bank about $4.40 per day, every day for a year, just for the privilege of carrying that $5,000 balance. The cost of a coffee, every single morning, for 12 straight months. And at the end of it, you barely move the needle. Now extend this. 5 years in, you still owe $2,735. 10 years in, $1,496. 15 years, $812. You finally clear the debt in month 230. That's 19 years and 2 months after you open the statement. Over those 19 years, you paid the bank $13,099.75 in total. $5,000 of that was the original debt. $8,099.75 was pure interest. You paid back 2.5 times what you originally owed for paying the amount your bank told you to pay. Now here's the part that should make you angry. That box on your statement, the one we just decoded, technically shows you all of this. The 19 years, the total interest, the savings if you paid more. The Card Act required the banks to tell you. They tell you every single month. But the box doesn't tell you this is a designed feature, not an accident. It doesn't tell you that the minimum payment formula, 1% of balance plus interest, was chosen by the credit card industry precisely because it keeps you paying for decades. It doesn't tell you that the bigger version of this law, the one that would have forced banks to make the warning bigger, louder, and impossible to miss, was killed during congressional negotiations. Banking industry lobbyists in 2008 and 2009 spent over $50 million fighting the strongest provisions of the Card Act. They lost on most of them. But on this one, the box, they won a critical compromise. The disclosure had to exist. It did not have to be prominent. In 2024, U.S. credit card companies collected over $130 billion in interest payments from consumers. That number has roughly doubled since 2014. Credit cards are the most profitable consumer banking product by a wide margin. They know the box exists. They know you don't read it. The Card Act gave you the information. It did not give you the habit of reading it. And the credit card industry has spent 15 years optimizing around the gap between what is technically disclosed and what is actually understood. So what do you do? 1. Pay double the minimum every month. On a $5,000 balance at 22% APR, doubling the minimum cuts your payoff time from 19 years to 5.5 years. Savings, $5,937. 2. Pay a fixed amount, never reduce it. $200 a month, flat, on a $5,000 balance at 22%, pays off in 2 years and 10 months. Savings, $6,349. 3. If you have multiple cards, attack the highest interest one first while paying minimums on the others. This is called the avalanche method. Mathematically, the fastest route out. Here's what to do tonight, before this episode is 2 hours old. Open your most recent credit card statement. Find the section labeled Minimum Payment Warning. Read the 3 numbers in the box. If the number of years shocks you, you are not alone. That is by design. Now you know. If this helped, subscribe. The rules they don't teach in school, but that determine whether you keep your money or lose it. Now you know. Use it.